Hi, everyone. So we're going to start. So welcome to the SynMax webinar, Producer Efficiency. I'm Sophia LaChapelle, an account manager at SynMax, and I'll be moderating the discussion today. So what you can expect from this webinar is a discussion on producer efficiency gains in the lower 48 for natural gas and oil production. We're going to start with some notes from our CTO, Eric Anderson, on the broader conversation around this topic, and then dive into some qualitative notes from our head of energy fundamentals, Tony Franjie, on what he observed from producer quarterly calls and from producer guidance. For those of you that are clients and attended our long-term forecast webinar last month, some of this may be a review, but with a greater focus on the topic at hand. Then we're going to dive more into the details, and our lead data scientist, Rahul Verma, will offer some quantitative analysis and data visualizations using both our proprietary daily satellite data, as well as some public data sources. We're going to be discussing completion times, fracking speeds, lateral feet drilled, IP rates, and more throughout the discussion. Then to close it all out, we'll hear again from our CTO as he adds some expert commentary and some conclusions on the discussion before we open the floor up to questions at the end. So feel free to stick around for that, or you can reach out to us at support@synmax.com with any questions or inquiries. So with that, I'm going to go ahead and pass it off to Eric.
Awesome. Thanks for the introduction, Sophia. Like she said, my name is Eric Anderson. I'm the Chief Technology Officer at SynMax. Happy to be joined here by our Head of Fundamentals, Tony Franjie, and our Lead Data Scientist, Rahul Verma. Today, we're going to be talking about producer efficiencies. This is a topic that I think is being widely discussed among different sell-side research firms. It's a hot topic right now. Obviously, from a gas perspective, we have had a rather flat summer in production, something that SynMax was anticipating in our production forecast, but this has led to a lot of emphasis and focus on producer efficiencies. The big question being asked is, are producer efficiencies continuing to improve? Are we seeing tier 1 acreage, particularly in the Permian, being used up? There's a lot of conflicting data sets out there, and the intention of today's webinar is to hopefully cut through all of that noise and give you a clear view of what we believe is going on. So with that, let me start with a little bit of data. I took this from Twitter. My intention by showing this slide is not to call out the person who created this tweet. I don't believe anybody is trying to spread misinformation deliberately, but I wanted to use this merely as an example of what the typical argument is against producer efficiency, particularly in the Permian. So this chart, on the left here, is a great example of what people are observing in the Permian that is giving them pause and leading them to the conclusion that producer efficiency is declining in the Permian. Perhaps that tier 1 acreage has finally been used up. Producers are going into tier 2 acreage. They're not getting the same kind of per foot results that they have expected in the past. And of course, if that were the case, this would be very important information right? This would essentially be saying that the peak for efficiency is in the Permian, the party is quote unquote over, and we need to be entering a decline environment or a decline mindset for the Permian for the foreseeable future. We do not believe that is the case. And I think some of the strongest arguments against that is that this information being shown here on the left is inconsistent with other facts that we know are true, right? So we know two things for sure. One is that in the Permian in particular, we're continuing to see production grow, right? So from the beginning here, we were at 12 BCF a day. We've seen that grow up to 13.5 BCF a day. Of course, everybody who's paying attention to the gas markets has seen that pull down somewhat because of pipeline maintenances, but the 13.5 BCF a day is kind of the high watermark in the Permian. And then the second piece of information is we're seeing activity decline. If you are a SynMax customer, of course, you get access to daily frac crew information, which I've got here on the screen. And of course, you have noticed that fracking activity, which is the most relevant type of activity production, has declined 30%. If you're not a SynMax customer and you're just looking at the Baker Hughes rig count, you've also noticed that we have seen a coincident decline in rig activity as well. The story is the same. We've seen a decline in activity and we've seen an increase in production over the same period. So how then could it be possible that we're also seeing a decline in producer efficiencies, right? And these are the three pieces of information that simply do not fit well together. So, the purpose of today's webinar is we really want to unpack in a lot of detail exactly how you can create these three different charts and put them together and have something that looks like on its surface is a complete contradiction. But in reality, the story is much more nuanced. It requires a lot of discussion, and that's why we brought in our experts here to help us tell that story. And I believe that SynMax in particular is in a unique position to be able to tell this story than anybody else. Okay, we have proprietary insight. If you're not familiar with SynMax, if you're not familiar with our product Hyperion, it is the only product in the world that uses daily commercial satellite imagery to track rigs and frac crews at every single well pad in every single major play of the lower 48. This is not only an extremely data intensive undertaking, this is a very expensive undertaking. I'm famous for saying we spend over $1 million a year on satellite images at SynMax, and that's part of the reason why there are no other companies out there that do this. We're the ones who have taken the big risk in purchasing this high quality data to be able to get answers on production. For anybody that's worked in the industry for a long enough time, you know that production is one of the most difficult data sets to get good data out of. You have state reported agency data, which in the best case is 4 to 6 months lagged. But in the worst case, which is the most common case, the information is wrong, right? So let's review the well life cycle. The well life cycle, of course, starts when a permit is filed, a rig shows up, you have a certain amount of drilling time. The well then becomes a DUC, a drilled but uncompleted well, which is a metric that people like to track very closely because they see it as the dry powder of production. What is possible in the future? What are producers building up in their DUC inventories? And then you have the frac job, right? The frac comes in, the frac leaves, and then there's this less commonly known TIL lag, turned in line lag. After the frac job leaves, how long is it before that well, the production hits the pipeline, right? And so if you're relying simply on the public data, really the best you can get is a spud date. You can get a spud date and you can get a turned in line date. The turned in line date, you can't get directly, you have to back into it. You basically have to take the first production date of the well, and then you need to apply a decline curve profile to turn that monthly number, right? Because they only report it in monthly increments back into an actual day when it was turned in line. But you're missing so much of the information, which is holistically a part of the efficiency story. SynMax fills in all of that data, right? We're observing all of these well pads. The moment the well pad is cleared, the moment the well pad or the permit is filed, we're observing it through drilling. We're counting the number of days that it's taking for the drilling rig to be there. It's really important we get this daily satellite imagery. Otherwise, we would not have this precise measurement of exactly how many days drilling is occurring. We're doing the same thing for the frac crew, right? The day the frac crew shows up, we are aware of it. And we're counting the number of days. How long is it taking them to perform this frac job? We have characteristics of the wells that are being drilled and completed. And then we can back into that, using this proprietary data set, what the efficiencies are. Are they getting more or less efficient? Are they able to complete more or less wells with the same amount of resources, right? These are questions that can only be answered when you have access to proprietary data, which SynMax provides. Before I pass things off to Tony, and he gets into kind of the qualitative view of producer efficiency improvements, I think a lot of this misunderstanding and discussion, especially what I've seen on Twitter, is around semantics. And that is that, people talk about efficiency when they really could be talking about one of two things, right? So for the purposes of our discussion, we're going to talk about efficiency in very precise terms. It's either going to be resource efficiency, which is the amount of hydrocarbons being produced per unit. So the unit could be a lateral foot, it could be a well, it could be a well pad, right? But a resource efficiency is improving some type of hydrocarbon return per unit, okay? As opposed to an economic efficiency, which is you are increasing your return per dollars invested, right? And the two are not always the same, right? So for examples of efficiency gains that have potentially different outcomes on resource versus economic efficiency, multi-well pads, right? So adding additional wells to the well pad, really, if done correctly, and you can avoid the parent-child problems which we've seen in the past, does not change your resource efficiency. Each well, if that parent-child problem is solved, produces the same amount of hydrocarbons. So you haven't changed your resource efficiency. What you have done is you've improved your economic efficiency, because now your drilling rig and your frac crew has less downtime in transit between different well pads, right? They spend more of their hours working on drilling and completing wells than they do moving between well pads. So that's an example of where you're not getting a resource efficiency, but you're definitely getting an economic efficiency. And then the other three big ones, zipper fracking, proppant improvements, and longer lateral lengths. Well, those are dependent, right? All of those things are likely to produce resource efficiencies, but not all the time, and not under all economic conditions and all geological conditions are those going to produce economic efficiencies, right? You know, you certainly with a better proppant you should get better resource efficiency out of a well, but you know that better proppant is going to cost more money, and is the geology going to support the number of hydrocarbons you need to make that investment back? So it's not necessarily an economic efficiency. So want to get these terms out of the way because I think semantics are very important in this discussion when we're talking about efficiencies. All right, so our agenda for today, after my opening remarks, like I said, I'm going to pass things off to Tony right here. Tony is going to give us the qualitative analysis of producer efficiency. So if you've joined us before, if you're a client and you've been part of our quarterly webinars that we do for clients, you know that Tony has the very unfortunate job of having to listen to every single producer earnings call and go through every single producer investor presentation. But you know, that is a gold mine of good data, right? And so there is this qualitative picture of producer efficiencies that is buried inside of those resources, which Tony has gone through the trouble of pulling out. He's going to present that first. Then we're going to pass things off to Rahul, our lead data scientist. Rahul is a data guy. He digs into the data. So that kind of qualitative picture that Tony is creating, Rahul is going to create the hard facts and data behind it to back it up and hopefully get, you know, take this from an anecdotal story of producer efficiencies into a hard story of what it actually means for the numbers. And then finally, I'm going to wrap things up by delivering out our actual forecast for the West Texas side of the Permian and discuss, you know, what producer efficiencies mean for this forecast and what customers can look for as the new frac crew data is coming out to see if that picture is going to realize or not. So with that, let me pass it off to Tony. Tony? Thanks, Eric.
Good morning, everyone. I'm Tony Franjie, head of Energy Fundamentals. I'll be going over the qualitative research from the public producer presentations on both economic and resource efficiency. And again, like Eric had stated before, it's important to distinguish between the two because oftentimes people don't distinguish both of those metrics, and they're very different and have different implications. So economic efficiency, like Eric talked about, more production per well, more production per frac crew, but mostly what's important when economics are dealing with money, and it's extra dollars out from what is put in. And as we'll see later, it's when we go to the third mile compared to the second mile, it's maybe about a 2-to-1, 2.5-to-1 ratio in terms of what you get out compared to what you put in, at least on a dollar-wise basis. Resource efficiency, predominantly what's looked at is production per lateral foot, and it's like the second derivative in terms of production, and it's a mixed bag in terms of resource efficiency. From what producers saying, some had more resource efficiency, more production per lateral foot, even with these much longer laterals, which is pretty credible actually, and some had flat. None of them actually showed lower production per lateral foot. But when they showed the overall Permian Basin, they showed, oh, look, it's a little bit lower production per lateral foot. But when the actual producers on their numbers, it was actually either higher or unchanged. So it was a mixed bag on that one. Overall final point, producers are significantly increasing economic efficiency, but not necessarily increasing resource efficiency on a per lateral foot basis year on year in 2023. And, you know, it probably has to do with the big increase in lateral feet year on year, which is, if you look at it back 13 years, it's going up on average probably about 10 to 12% per year, which is pretty big when you compound that over 13 years. And now at these much longer lateral feet, average per well, 10% growth is a big number in terms of the footage. How far have we come? It's pretty incredible. If you look what Occidental has stated, a couple examples. They recently drilled a 10,000 foot lateral well in 24 hours. 10 years ago, they said that would have taken 15 days. So it's pretty crazy how much more efficient or they're getting on that. And then in the Delaware Basin, they recently broke their continuous frac pumping time by 12 hours to a total of 40.9 hours. And only 4 years ago, that would have taken 84 hours to do. So they cut that by more than half in 4 years. One metric to look at that we calculated here in the Permian on the natural gas production. This is the total Permian, New Mexico, and West Texas put together. And looking at the total frac crews in the Permian, we can see how in 2022, the production was 16.9 BCF a day. And in 2023, it's about 18.1 BCF a day. And, you know, we're getting close to being done with the year, not too far off. And at the same time, frac crews fell from 123 in 2022 to 113. So you can see more production at the same time, lower frac crews. It's a simple metric, but the year-on-year increase on that in the yellow is 17% year-on-year in terms of the change in production per frac crew, which is one, you know, efficiency metric to look at, resource efficiency. Typical of producers since 2019, Antero Resources demonstrates some of the drilling and completions efficiencies. 93% increase in completion stages per day since 2019. Drill out feet per day, 52% increase since 2019. And reducing the cycle times per pad, they've reduced it by 65% since 2019. So it's pretty crazy. Antero is a Northeast producer, granted, in the Marcellus, but this is still very typical of all the other producer efficiency metrics. If you look at what Coterra is doing in the Wolfcamp Basin, which is in the Permian, they have a project going on called the Windham Row, where they're developing. It's a 51 well project, and what they're doing, they're simultaneously drilling the well, completing the well, and bringing it online, all within a very short period of time. And it's overall causing their cost per dollar on a dollar per foot basis to drop 5 to 10%. And so it's been a pretty successful project so far. And this is an example of an economic efficiency big time. And they'll have many more of these projects to go in the future. One interesting thing that Chevron looked at, they basically looked at their current 2-mile lateral wells and how they were performing in this year compared to last year. And even with that, they're getting significant increases in production on a per 2-mile well in the Midland Basin, the Delaware Basin in Texas, and the Delaware Basin in New Mexico. Well, maybe not so much in New Mexico, but definitely in Texas and the Midland, they've been able to increase the performance there. And this primarily probably through simultaneous fracking. And this is one example of a resource efficiency. Another interesting thing to look at, just the drilling records. It's pretty crazy. EQT recently in the Marcellus, they drilled an 18,200 foot lateral in 48 hours. So it's an increase of 5% from the old record, and it's just pretty incredible what they keep setting each and every year. And the important distinction here is these monster laterals, these 3-mile, call them 15,000 foot or greater laterals. This process has been implemented very successfully in the Northeast for at least the last several years. And it's really only recently now being implemented in the Permian. So this process has been done before successfully, and they're clearly implementing it successfully now in the Permian and should continue these greater efficiencies, both resource and economic, in the Permian as compared to what they've done in the Northeast. If you look at their completion records, and again, this has been done the last several years in the Northeast before the Permian, they recently completed a 20,818 foot well, recently EQT in the second quarter. So it's pretty amazing. It's almost a 4-mile lateral well. Pioneer Natural Resources, a dominant producer in the Permian, an example of a economic efficiency. Basically, more production, more dollars coming out at the same time, lower maintenance capital. So higher production, lower maintenance capital. Nearly every single producer had something like this. The only ones maybe were the Gulf of Mexico producers. But other than that, nearly every producer had the same thing. Oh, we're increasing our production guidance in the second quarter while we're simultaneously reducing capital expenditures. And it was basically like a 3% increase or anywhere from 1 to 3% increase in their overall annual production guidance, while at the same time we're reducing CapEx by even greater amount than that. And looking at the resource efficiency metric, Pioneer actually had higher production per lateral foot in 2023, even with the big increase in lateral footage overall. So it's pretty incredible what they're doing there in the Permian. Again, an example, the curve on the right there, the extended lateral length productivity, basically shows how much cumulative production you're getting with the 15,000 lateral foot well compared to the 10,000 lateral foot well. And it's pretty amazing. It especially accelerates starting in month 6 into the well. Basically, you get a 35% higher IRR when you go to the 3-mile lateral well compared to the 2-mile lateral well, with a 15% decrease in capital costs or 15% capital savings. And Pioneer plans on doing 1,000 more different locations with these greater than 15,000 laterals, called monster laterals. They plan on doing this in 2023 and in 2024. Again, an example of both economic and resource efficiency gains. Callon Petroleum showed a mixed bag here. They actually had flat production per lateral foot year on year in 2023. And when they show the industry overall, they show a decline of 8% in terms of production per lateral foot year on year. But even if it really is the case, that decline, it's way more than offset by the increase in lateral footage overall from the producers in the Permian. Devon Energy showing some examples of economic and resource efficiencies. Q2 wells attained peak rates of 3,000 barrels of oil equivalent per day. Wolfcamp drilling productivity improved 10% versus 2022. And record completion pace averaging 2,200 feet per day in Q2. That's an improvement of 9% versus 2022. So it's kind of interesting. It's close to double-digit year-on-year gains, basically, in terms of, at least for sure, economic efficiency gains. Diamondback Energy actually showed some flat resource efficiencies in terms of production per lateral foot compared to a year ago. So again, I mean, it was a mixed bag in terms of the per lateral foot production, but even then, it just didn't matter. The lateral footage is increasing so much that we're able to produce more with fewer fracking crews and even with fewer rigs as well, ultimately, even though rigs don't lead to production immediately, obviously. Chord Energy, they did an interesting take on the difference between the 3-mile and the 2-mile. And they basically showed a 20%, while the 3rd mile increases your well cost by 20%, you get a higher production based on the EUR estimated ultimate recovery, 40 to 50% increase in the EUR, the ultimate production. And that's about a 2-to-1, 2.5-to-1 increase in terms of what you get out of the well versus how much money you put in. So definitely a big increase in economic efficiency. The 3-mile laterals also increase the D&C cost per lateral by 22% compared to the 2-mile lateral. So it's just another really interesting metric. Overall summary, what is happening with the Permian with much longer lateral length wells? Again, as we said before, it's been successfully implemented in the Northeast for the last several years. So this isn't something that's new. These guys know it. It's been implemented for a while. It's just now being done in the Permian, and it's being done very successfully. And it should successfully be implemented later on much more. And the only thing really holding it back, if it is being held back, if you want to say that, is just the lack of pipeline or the ability to put pipelines on is really your only constraint at this point. And all producers are becoming more efficient, but they're doing it in different ways. So the broad metrics: completion time per well, continuously lower average time per well, pretty much every single year. Frac feet per day per well, keeping up with the pace of increasing lateral lengths. And again, we talk about the monster horizontals, 3 mile plus, geospatial distribution formation. Rahul is going to go into more of this. He's our lead quantitative analyst, and he will go into this in detail.
Thanks for the intro, Tony. So like Tony just mentioned, what I'm going to try to do with my section of this presentation is basically drill down into the data. So Tony has given you a lot of very convincing, one-off examples. Like there are several completion records being set by individual operators, drilling records. Operators just seem to be getting faster and faster with how fast they are with completing new wells. And also there's these anecdotes from individual operators about increasing productivity per lateral foot, which sometimes doesn't square off when you look at some charts floating around on Twitter. So what I'm going to try to do is just go into our proprietary data, which, like Eric earlier mentioned, there really is no parallel to that satellite-derived completion data out there. So it really gives you a very good insight into what's overall going on in the Permian. So the first metric that I kind of settled on was basically completion time per well. Now, as you can see, the frac crew number, it keeps going up and down, and you can also derive how efficient frac crews are in terms of completions, like just based on the number of frac crews. But you can also go by individual well pads. So the number of wells per well pad also keeps changing, and they are also changing the total number of feet per lateral feet which they are fracking, right? So it almost looks like they are doing much more per well pad. So then when you look at completion time per well across the entire Permian, and I'm looking at fairly recent data. I'm not looking at like data from like 10 years ago. This is starting in the fall of 2020, which is when we started collecting our satellite data. And you see a very clear, definitive trend of completion time going down across the whole Permian. Now, of course, there is a lot of noise in the data. This is across thousands of completions across the entire Permian. So there is definitely noise. And some of the noise which I wanted to call out was if you look at the periods around the winter months, especially when there were those freeze-offs in the Texas region. So you'll see a sharp jump up in completion time. Another thing, very interesting thing to call out is these jumps in completion time, they happened in January 2021 and January 2022. But if you look at January 2023, which is this year, those jumps in completion time appear to have been resolved to a very large extent by the operators. And again, these are not like statistical aberrations. This is a very large sample of wells. This is all the completions going on across the Permian, which is a very large sample set. So when I started this analysis, I was actually worried there would not be a clear trend, but like now you can convincingly see we start at somewhere around the 7 days completion time per well back in 2020, and it's now down to almost 5.5. So across the whole region, that is a very significant decline in completion time per well. And then if you look at the top operators in the Permian, which is just going by, the last 12 months, which are the operators which have been completing the maximum number of wells, the trend also seems to hold pretty good. Like you see completion time steadily declining, but if you compare it to the previous graph, there does seem to be much more noise, but which is not surprising because you have a lower sample per operator, so the amount of noise is almost inevitably going to go up. But even here, like the trend holds. So drilling down a bit deeper into that operator level analysis. So firstly, I plotted, so which are the most prolific operators in the Permian for the last 12 months, right? And so some of these names are very obvious, like Pioneer is the leader in this number of completions for the last 12 months. What at least was a bit more interesting to me was that I tried to quantify how much improvement individual operators have seen compared to when we started collecting our data in 2020. And here, like, you really see some kind of outliers. So for example, I've only plotted operators which have a significant number of wells, right? So it's for top 20 operators. So all of these 20 operators, they have completed a very large number of wells in the last 3 years. So across all of those wells, you see like Oventive, it has a 60% reduction in completion time per well, which is quite significant. And another very significant one is, again, Pioneer, which keeps coming up in these analysis, because Pioneer they're completing a very large number of wells compared to everyone else. And even then, they're achieving very significant growth in their efficiencies. There are some very top tier operators like EOG who actually did not do that well in this metric, but specifically for EOG, they were already achieving very good completion times even back in 2020. So this data doesn't quite show how good they already are. And one thing to also call out in this is, as you saw, there was a lot of noise in this data. So it is quite obvious that these completion times, they don't decrease linearly. So it looks like operators, they will try out these new technologies in a few well pads, then they kind of work out their economics, and then they slowly start to kind of propagate these learnings across all of their well pads. So any kind of a major breakthrough in technology, it takes some time for it to propagate to all of the well pads. Okay, so that was for completion time. So another metric which I wanted to look at was fracking speed. Now, both Eric and Tony have kind of touched on this, but we are seeing a very clear trend of increasing lateral lengths across the entire region, right? So here I've plotted average lateral lengths across all of West Texas, right? And if you just compare the averages, it has grown about 20% versus 2020. Now, if you just look at the outliers on the top right chart, you'll see that the number of wells above 14,000 feet, that there's a clear line where the 14,000 feet marker is, and you'll see like a very clear increase in the number of wells which are being finished above 14,000. So that's kind of the cutoff point which I use to define these monster laterals. So of course, in industry parlance, they often talk about 3-mile laterals, which is a bit higher, like 15,000 feet. But I just use like a strict data cutoff, saying that okay, 14,000 feet, more than 14,000 feet is where the monster lateral line is. Okay, so based on this, like increasing lateral length, increasing wells per well pad. So how can you incorporate both of those parameters into a single metric? And this is how I came up with the fracking speed. So what this is trying to quantify is it's saying that if a frac crew arrives at a well pad and we are seeing increasing lateral feet, so what is the total number of feet per well pad which they are trying to finish? So this is and how many days did they take to finish all of those additional fractured feet? So this is what this fracking speed is trying to quantify. So as before, there is still noise in the data. There is still seasonal trends, but you'll see a very clear linear increase in the across the entire Permian for feet frac per well pad per day. And again, here you can again do an operator level analysis, and the same trend holds, and which here there's less noise in it, and there's more clear growth in, even if you drew a straight line across it, there's a clear growth of around 20 to 30% for almost all the operators. Like they're just getting much better at this total fracking per well pad. Okay, and so as I mentioned, touched on it in the previous slide, so I created this criteria for monster laterals which are like a little bit over 14,000 feet. So first off, across the entire region, we have like a very, this is not even linear, it's a more of a non-linear growth in the increase in the number of laterals which are greater than 14,000 feet, right? So, so there's much less, noise in this kind of a trend. And this is also just in the last 3 years, from fall of 2020. So this kind of a change, it does indicate we are almost like at an inflection point in this change of technology which is going on in the Permian. Then one of the things I also wanted to look at was, okay, so they're drilling more and more of these laterals. So which formations are they actually targeting for this? So in this, the formation distribution, it's not super surprising. Like it's mostly being drilled in Strawberry and the Wolfcamp, with the Strawberry being significantly ahead. One thing to take away from this is that Strawberry, geologically is a much tighter rock than Wolfcamp. So it may affect fracture creation efficiencies, which may be responsible for some of the noise that you see in the production per lateral foot. The Wolfcamp is a much more mixed rock. There's shale, there's carbonates, there's sandstones all mixed up in the Wolfcamp. So that would explain at least some of these differences between how efficiently the fractures are being created, and then you back into the productivity per foot. So that was just for like a brief overview of the geology. For getting a better analysis of these fracture creation efficiencies, unfortunately, you need much more granular data, like which perhaps even operators don't collect. So so you can only make these qualitative analysis of as far as the quality of the rock versus the fracture creation efficiencies go. Okay, but a more interesting one is just to look at the distribution of these monster laterals by operators. So if you look, if you paid attention to the earlier chart, which had the total number of completions by operator, then the chart looked pretty evenly distributed. But here, the Pioneer is by far ahead of everyone else. Like it's ahead of the next two guys put together, and the next two guys are, one of them is ExxonMobil. So that is a pretty remarkable kind of a statistic, because we are still talking about a very large number of wells, and this is quite a shift in economic efficiency if you just look at it. So the Pioneer really looks like they're going all in on these monster laterals. And the other one is, so that was for the past 3-year history. So if you look at the near-term outlook, so what does this mean? Like how are these trends going to hold up for the next few months? So you can just look at the ducts. Now, there are some caveats for looking at the ducts, so a lot of these wells may not have been drilled yet, so they will not show up in the ducts. So like Tony mentioned earlier, Pioneer has publicly announced that they're going to drill 1,000 monster laterals over the next 2 years. So they're also not going to show up in the duct data. But even so, you will see in the duct distribution, the proportion of these monster laterals is quite significant. Like it's so for the next year or so, this proportion is definitely going to show up in any kind of a production forecast. So topics like how productive these monster laterals are per foot they are definitely very important things to keep an eye on. Again, if you look at the distribution by ducts, Pioneer is still like the leader here. But an interesting part is that ConocoPhillips, just going by the percentage of these monster laterals in ducts, ConocoPhillips is actually the highest in all the top operators. So they don't have the maximum total number, but just by the proportion of monster ducts, Conoco is really far ahead. So another interesting thing for Conoco would be just to see how that strategy pays off for them, because Pioneer still has a number of completions which are not monster laterals. So so yeah, so this so that kind of puts into perspective everything going on in the Permian. We have also heard earlier in this webinar about how this strategy has been successfully implemented in the Northeast already, and it is only now like that the Permian is sort of adopting these monster lateral strategies. So, so if you just, so I just compared some of these same metrics across basins. So, so I did an analysis across the Permian versus the Northeast and the Haynesville. So one thing, and this is not a very surprising metric, it's that gassier regions like the Haynesville and Northeast have taken longer to complete these wells. More,
Rahul, we seem to have lost your audio.
Can you hear us now?
Yeah, there you go.
Okay.
okay, so
How far back should we go, Sophia?
Just
This
like the
slide or
past
the
slide.
previous one?
That slide's fine, yeah.
This slide's fine? Okay.
all right. Okay, so so just to kind of redo this slide. So once I was done with sort of evaluating what was going on in the Permian, I then tried to do an analysis across regions. So I did an analysis across the Permian, the Northeast, and the Haynesville. So what are the trends kind of looking at like there? You see some of the similar trends like the wells per well pad and completion time per well kind of trending downwards. One interesting thing is that the spikes in the wintertime, which happened for the Permian in the previous 2 years, they also happened in the Northeast and Haynesville. However, this year, like in January 2023, that spike in the completion time did not happen for the Permian, but it did still happen in the Northeast and the Haynesville. So whenever the next freeze off comes, I don't know if this trend is going to hold for the next freeze off as well, but it looks like the Permian has somehow recovered they have figured something out on how to deal with these wintertime freeze-offs. Okay, and one other thing was, this was just me trying to evaluate why there is a significant difference in these completion times, and also just why the Northeast were the first one to kind of start doing these monster jobs, because the number of wells per well pad in the Northeast is significantly higher. And also they have been doing like these 3-mile and even 4-mile laterals much before the rest of the country. So this is something we consistently see in our satellite data because we have to deal with it. Like for collecting these satellite observations, we have to know the exact location and the size of well pads. So this is something that we have had to deal with from a satellite point of view. But one thing, this is just looking at the data itself. It's that the inter-well pad spacing in the Permian is much, much tighter than the other regions. And these, they all have the same x-axis, these graphs. So the lower one is showing it for the Permian, whereas the other ones are for the Haynesville and the Northeast. So the Haynesville is kind of in between the two regions, but in the Northeast, there's a very clear shift on how much more the inter-well pad spacing is. So this larger spacing in the Northeast provides a strong impetus for larger jobs. So if you're trying to achieve economic efficiencies in the Northeast, it makes way more sense to try to do jobs which are as large as possible. So this is kind of the end of my section of the presentation. I'm now going to hand it off to Eric again to sort of complete the picture.
Thanks, Rahul. All right, so there was a lot of information in that, obviously. I I think we've painted a really good qualitative picture from the operator perspective of why they believe they're improving their efficiencies. Rahul did an excellent job also backing that up with our own observations and our own data that shows also we're improving efficiency. So let's take it all home. Let's talk about this theory that is kind of floating around right now about the Permian declines, and why we believe that it is incorrect, and how you could kind of generate this chart with all correct data, right? Not intentionally trying to mislead anybody, but ultimately this is not the correct way to look at it. And really, the reason is that the Permian is a very large, very diverse region, right? So we all know that there is the Midland and the Delaware, which are the key plays inside of the Permian. What a lot of people don't appreciate is the fact that there are half a dozen or so formations layered on top of each other inside the Permian. And they all have, as Rahul was discussing, very different geologies that react in very different ways. So any type of analysis on the Permian has to account for and appreciate exactly where the activity is, right? And that's why I feel like this chart on the left here is somewhat misleading, is because it's not accounting for the activity. And to illustrate that point, I put a chart of gas IPs, right, for different counties in the Permian. And the same thing is true with oil IPs, by the way. I know in this discussion we've talked a lot about gas, but this story is directly applicable to oil as well. It's just there's a lot more data available for gas, so it makes sense to start there for your analysis. With pipeline scrapes and everything being so much more available on the gas side, you can see that if I was drilling primarily for oil and I was drilling in the Midland Basin, the gas return numbers would be a lot worse. And if I was drilling over in the Delaware side, maybe in Reeves or Culberson County, and I was drilling primarily for gas, then the oil returns would be worse, right? So there is a very important factor of where my activity is. If I'm going to make these average across Permian charts, where I'm trying to describe a much larger story for a very diverse, very large region, right? So I could easily produce misleading statistics about the region as a whole by just taking the average of the region without really accounting for what is getting baked into that average, right? Are we drilling into Wolfcamp? Are we drilling into Strawberry? Are we in the Midland? Are we in the Delaware, right? All those things absolutely are going to have an outsized impact on the results. And this chart here on the left is just blending that all together and obscuring, making it more opaque to be able to see that picture. So the type of analysis that we like to do when we're trying to answer the question, is there IP rate degradation, right? Are producers out of tier 1 acreage? Have they started moving into tier 2 acreage? Is account for all of those different variables, right? And so that's what we've done in these next couple of charts. So the first thing we've done is we've grouped all of these wells by their IP rate bucket into 2,500 feet. And then the second thing we've done is we've shrunk the collection of wells down to just a particular formation. So this is the Strawberry formation. And as you can see, for the longest lateral wells, right, for 2023 wells, we are above 2022 levels, definitely above 2021 levels. Probably ignore this number because the sample size is very small. Lateral lengths have been growing. This is probably biased by exploratory wells, looking at drilling longer wells in 2021 for 12,000 feet and above. But you can see that the story of IP rate degradation fails to hold water when you account for all of the individual buckets that need to be taken seriously when you're doing this type of analysis. In fact, if you look at this, there are 5 different categories. 3 out of the 5 show improvements in 2023 IP rates, and 5 out of 5 show versus 2022, and 5 out of 5 show improvements versus 2021 and 2020. So clearly, the story that we have run out of tier 1 acreage is not correct in my view. How much tier 1 acreage is there? When are we eventually going to run out of it? Well, that is a topic that is also going to require another completely separate webinar to unpack, because there's a lot of discussion there. At a very high level, right, I think people's mental model of tier 1 acreage is wrong, right? So people think about it as there's this finite amount of tier 1 acreage, and every year it shrinks, right, because we're using more and more of it. The reality is that there is a countervailing force called technology. As technology improves, more acreage becomes tier 1 acreage, right? This is the story of the shale revolution. Tight shale was, tier infinity acreage. It was unrecoverable until technology unlocked it and turned it into tier 1 acreage. And that continues to happen. So while we continue to draw down on this imaginary finite quantity of tier 1 acreage, technology is pushing that quantity of tier 1 acreage higher and higher. The exact split, right, which force is overtaking the other, is a discussion that we can unpack in another webinar. All right, and so same type of analysis we did on the previous slide, this time for the Wolfcamp. We picked the Wolfcamp and the Strawberry because they are the most important formations in the Permian. But you see an even more clear picture that in 2023, per lateral group, all within the same formation, right, 4 out of 6 categories here are producing much higher IP rates. Clearly, there is not an IP rate degradation when you account for all the necessary variables. So the other trend that we talked about, which is really important, is that IP lateral lengths have been growing. Now, Rahul touched on the discussion a little bit earlier that, hey, per lateral foot, are we seeing degradation in quality, right? You're going from 2 miles to 3 miles in lateral lengths, but does each additional lateral foot yield a little bit less hydrocarbons? We dug into the data very deeply about this, and the answer to this question is going to vary one geologist to the next, right? So Rahul, he's a PhD petroleum engineer. His opinion is that no, there is no clear relationship to say that there is IP per lateral foot degradation. But you know what? If you go onto that, and I don't mean this disparagingly, but if you go onto the next geologist or petroleum engineer, they will say yes, there is a degradation. The estimates we've heard from the camp that says there is a degradation are between 5 and 8%, right? So we're losing 5 and 8% in the absolute worst case degradation of these lateral lengths per foot. Yet lateral lengths have grown 30% over 3 years, right? So 5 to 8% loss versus 30% growth. We're still producing resource efficiencies by growing lateral lengths, no matter who you ask. Likewise, wells per well pad is improving. This is in an economic efficiency. They're putting more and more wells onto the well pad. They're resolving those parent-child problems that we've seen in the past. The technology is improving, right? It requires exceptional directional drilling technology to correctly place wells on well pad and increase the number without causing parent-child problems. And we're seeing that trend manifest itself. All of that is to say, when you take all of these different trends, right, we're bringing it home kind of to the final conclusion here, right? What are the number of completions per frac crew in the Permian? And I also included the Eagle Ford because it tells a very similar story that companies are achieving over the 3-year period that we've been collecting the satellite data. And it is a 20% improvement, right? That may sound insignificant, but remember, that is to say that what it took to complete a group of wells 3 years ago, just 3 years ago, you need 20% less frac crews to do that today, right? You manifest that over the course of years and years and years, and you're talking about a much larger number of completions per frac crew. And then you need to account for the fact that these wells that are getting completed are 30% longer than they were in 2020, 3 years ago. So we're completing 20% more wells per frac crew, and the wells that we're completing are 30% longer than they were just 3 years ago. This to me is the ultimate testament to the fact that efficiencies are continuing. Both economic efficiencies and resource efficiencies have not stopped in the Permian. This is something that anybody who's forecasting production in the Permian needs to account for, because producers are proving that they can do more with less. And yes, I mean, there's no such thing as a 100% efficient engine. There's no perpetual motion machine, right? There is some theoretical limit on efficiencies. We continue to see steady growth in efficiencies, at least for the foreseeable future. So, for the next several years, I think it is safe for people in their models to assume that we're going to continue to see improvements in efficiencies. There's no sign yet that that is drying up. All right, so my final slide, kind of wrapping up the presentation, is I wanted to show the SynMax forecast for the West Texas, that's the Texas side of the Permian. I wanted to highlight kind of, what we've seen in the frac crew activity and what the frac crew activity needs to do in order to realize our forecast. So we believe that essentially on the West Texas side of the forecast, we are going to see more or less flat, slightly higher production through the end of this year. But going into 2024, we believe it's going to enter growth mode again. We've got a steep contango curve working in our favor. We've got lots of favorable economics when it comes to oil. We've also have great data coming from public producer earnings showing that 2024 is going to be a growth year. And that's why we're expecting the Permian on the Texas side to continue to grow. And you can see that steep curve right here. So what does that mean for frac crews? You see past frac crews over here, right? So in the past, in order to hit this growth period right here, we needed about 90 frac crews. If you average this out, you get to about 90. 90 frac crews is what it took for the Permian to get its last leg of growth. And we believe that is approximately what it's going to take when we model the data out for it to get its next leg of growth. So what we're telling clients is, watch the daily frac crews in West Texas. If you want to see if the SynMax production forecast is going to be correct, then by November, you need to see frac crews start heading up towards 90, right? The great thing about frac crews is there is a lag from when the frac crew shows up until when production hits the pipe, like we talked about previously. And so this is a great leading indicator of if this forecast is going to realize or not. So for SynMax customers, watch those frac crews. In order to know if this forecast is going to realize, you simply need to, by November, be seeing frac crews following this trajectory up to 90 crews. Now, you'll notice that later in 2024, we have it flatlined, and that is because we're baking into our production forecast the reality that we're going to start hitting takeaway constraints at that point. And then once we hit those takeaway constraints, it takes fewer frac crews to maintain production than it does to grow production. So that's why you see it peaking at 90 and then kind of pulling back into the low 80s. Because at that point, that is the only number of frac crews that you're going to need to just maintain production. Now, between now and the end of 2024, a lot of things can change, okay? We can have different pipes come on. We can have different efficiencies manifest. There's definitely a lot that are risks to this forecast, but our best view using today's current conditions and the data that we have available to us is that we expect to see West Texas natural gas production grow through kind of mid-2024 before it hits those takeaway constraints. All right, appreciate everybody who stuck with us through this very long and detailed webinar. I'm sure we've got some questions. So Sophia, if you wanna start with the Q&A, we're happy to take those questions in person. Otherwise, email us, info@synmax.com if you're not a customer, support@synmax.com if you are a customer, or you can email us directly, rverma@synmax.com, eric@synmax.com, Franjie@synmax.com. All right, Sophia, let's go to the Q&A.
Yeah, so we got some submitted. One is your forecast assigning wells that are being completed by your frac spread data to the various zones, and if so, how?
Yes, I think Rahul can dig into the details on that.
So our forecast, especially the short-term forecast, is a well-by-well forecast. So we try to get as much metadata as we can. At the very minimum, every single well being forecasted will have a surface hole, a bottom hole, the depth, and a lateral length. So the depth, the surface hole, and the bottom hole, that kind of fixes which formation you're going into. So like for a basin, you have a very good idea about, and we also have metadata about whether it's the Wolfgang, whether it's Strawberry, or Wolfgang ABCD. So yeah, absolutely.
Okay, we have another one. Have efficiencies plateaued in the Northeast?
The answer is no. They're still drilling long, they're still hitting new records in terms of well depths, and the laterals are getting longer, and they're doing it with even fewer frac crews. So they're becoming more efficient in the Northeast. They have no choice now but to, because there's just kind of no hope for new pipe other than, they got Mountain Valley Pipeline, but I mean, that was just a freaking struggle to get that thing on. It took years. So
they have to Congress.
They took it active. So they have no choice now but to get a lot more efficient as they can, because it's kind of hopeless for them in terms of getting new pipe on there. So the answer is no. They're still getting quite a bit more efficient.
Are you seeing any private producer ramp in the Haynesville as we head into a more supportive winter strip?
Wouldn't you like to know? Sorry, so this is a public webinar. We're going to keep it focused on producer efficiencies in the Permian. If you are a client, please email me. I'll be happy to answer your question. But Information like that is extremely market relevant and is for client eyes only. Next question, please.
He said he had to try.
I respect it. You got to shoot your shot, man. Tell your boss to stop being cheap and buy SynMax.
Next question. Sounds like flaring increase, especially in the Midland. Can you give any color on flared volumes in the Permian?
So flaring is something that we do not track. I know there's a number of satellite models out there that use the night fire data set to track it. We looked at the night fire data set and we feel like it's really, because it's 1 square kilometer resolution, which means you get 1 pixel of information for every 1 square kilometer. So all you can track with that kind of resolution is really big flares. And most of the flares in the Permian are small flares, and you can't see them on that satellite data. So I mean, I don't know what data set you're looking at. You could be looking at the actual, lagged TRRC flare data, and maybe it is showing an increase, and perhaps Tony has a view on that. But if you're looking at a model that's using satellite data, I have found the R-squareds on those models so bad, I can't even comment on any change in that. Tony, do you have any view on flaring?
One thing on flaring, the state of Texas passed a tax incentive. It became effective September 1st of this year. Basically, it depends on the wells, but if you're able to reduce flaring to a certain amount or make it 0, you get the 7.5% severance tax rebate, basically tax-free. That 7.5% of the price of gas, natural gas would be, assuming $2 natural gas, would be 15 cents an MMBtu. So the state of Texas is now giving the carrot and financially incentivizing producers to reduce flaring as much as they can. A lot of it is from lack of pipe, at which we've got 2 expansions coming on. With the Whistler pipeline expansion, 0.5 BCF a day, and then the Permian Highway expansion, another 550 million cubic feet a day. So I would expect flaring in Permian to come way down over the next year.
Het, it seems like you had your hand raised for a little bit, so if you want to ask your question, unmute and ask your question. Or if anyone else has a question, wants to unmute and ask.
You don't have to ask your question in front of the crowd. If you want to, you can email us. We'll answer your question. Even if you're not a client, if it's related to producer efficiencies in the webinar, we'll answer your question. So if you're not comfortable speaking or typing it in, that's perfectly fine. info@synmax.com. We will get back to you.
We have another one came in. Any quality issues on crude or gas affect this? I think it's the flaring.
Quality issues, none that I know of right now.
I think you might have to speak up because we have to switch microphones.
I don't know of any right now in terms of oil gas quality issues. The main constraint is just pipeline capacity on the nat gas side in West Texas, which is going to be resolved over the next 3 months anyway, until they fill up the pipes again, and then with more natural gas, and then they'll have another constraint in pipe probably in the second half of next year in the Permian.
Okay, so that seems to be all the questions that came through. So yeah,
Awesome.
everyone can just reach out at the email, support@SynMax or info@SynMax. We're happy to tell you more, answer any more questions.
Everybody have a great weekend. We will get to your questions as soon as we can if you send them, like Sophia said, to info@synmax.com. Thanks a lot.